You walk into your lender's office, you sit down, you fill out a mortgage application, you authorize a credit check, and within minutes, sometimes before you've even left the building, your phone starts ringing. Texts from numbers you don't recognize, emails from companies you've never heard of, voicemails from loan officers you've never spoken to, using your first name, referencing the fact that you're in the market for a home loan, one after another after another. You didn't sign up for this. You didn't give out your number. You didn't visit these websites. You applied for a single mortgage with a single lender, and somehow a dozen other companies knew about it before you got home. If you've ever experienced this and assumed your lender sold your information, they didn't. What happened is stranger, more systematic, and until very recently, completely legal. It's called a trigger lead. And for decades, the three major credit bureaus, Experian, Equifax, and TransUnion, have been making money by selling your most vulnerable financial moments to the highest bidder. In this video, you'll learn exactly how the trigger lead system works, why the credit bureaus are incentivized to sell your data at the moment you're most stressed, the landmark law that just banned this practice as of March 5th, 2026, and what you still need to do to protect yourself, because the ban has limits that most people don't understand. Let's start with the mechanics, because the system is more sophisticated than most people realize. When you apply for a mortgage, your lender pulls your credit report. That credit pull, called a hard inquiry, hits one or more of the three major credit bureaus. The bureau records the inquiry. Your credit file now has a fresh flag that says, this person is actively seeking a mortgage. Here's where it gets interesting. Under the Fair Credit Reporting Act, the FCRA, the federal law that governs credit bureaus, bureaus were permitted to use that inquiry as a signal, not just to report your credit history to the lender who pulled it, but to identify you as a consumer in the market and sell that signal, your name, your contact information, your general credit profile, and the fact that you just applied for a loan to other lenders. These are trigger leads. The trigger is your credit inquiry. The lead is you. And the sale happened fast. Not days later, not next week, within hours, sometimes within minutes. The bureau packaged your data and delivered it to competing lenders, lead aggregators, and third-party marketing companies who had paid for access to that feed before your lender had even finished processing your application. A dozen of their competitors already knew you were shopping. The result was exactly what you'd expect. Your phone exploded. Not because something went wrong, because the system was working perfectly for the bureau and for the companies that bought the lead. The only person it wasn't working for was you. Now, let's talk about why this was so damaging beyond the annoyance factor. Because the real harm wasn't the phone calls, it was the timing. A mortgage application is one of the most cognitively demanding financial moments in a person's life. You're trying to compare rates, evaluate loan terms, understand closing costs, and make one of the largest purchasing decisions you'll ever make. Your stress is elevated. Your decision-making bandwidth is constrained. And the stakes are higher than almost any other financial transaction you'll encounter. This is exactly the moment the trigger lead system chose to flood you with competing offers, not helpful information you requested. Unsolicited pitches from companies using high-pressure tactics because they knew from the credit bureau data that you were an active buyer with a narrow decision window. Many of these solicitations were designed to look like they came from your original lender. They'd use similar branding, reference your recent application, and imply a relationship that didn't exist. Some would claim to offer a better rate without disclosing that the rate was introductory or adjustable or subject to fees that negated the saving. The borrower, already overwhelmed, would sometimes switch lenders based on a misleading pitch, not because the new offer was genuinely better, but because the volume of incoming messages created a sense of urgency and comparison anxiety that made it impossible to think clearly. Mortgage industry professionals called this lead hijacking. Consumer advocates called it a privacy violation hiding behind a legal loophole. And the credit bureaus called it a pre-screened offer, the same category as those pre-approved credit card mailers you get, which gave them legal cover under the FCRA to sell the data without your explicit consent. Let me make something clear about the economics, because this is where the incentive structure reveals itself. The credit bureaus are private, for-profit companies. Experian, Equifax, and TransUnion are not government agencies. They are corporations that make money by collecting, packaging, and selling consumer financial data. Trigger leads were a revenue line. Every time you applied for a mortgage and your credit was pulled, the bureau could sell that signal, your identity, your contact information, the fact that you were borrowing, multiple times to multiple buyers. Each sale generated revenue for the bureau. The borrower generated no revenue for the bureau. The lender who pulled the credit paid for the inquiry. But the competing lenders who bought the trigger lead also paid, often more because the lead was warm. The consumer was confirmed to be in the market right now today. So the bureau bureau was incentivized to sell as many trigger leads as possible to as many buyers as possible, as quickly as possible. Your moment of maximum financial vulnerability was their moment of maximum revenue opportunity, and the FCRA, as written, allowed it. This went on for decades, since the mid-1990s. Millions of mortgage applicants, millions of trigger leads sold, billions of dollars in bureau revenue generated from the data of consumers who never knew their intent to borrow was a product being sold in a marketplace they couldn't see. Now, here's the update, and it's a big one. On September 5th, 2025, President Trump signed the Homebuyers Privacy Protection Act into law. It took effect on March 5th, 2026, just weeks ago. This is the first federal legislation to directly restrict the trigger lead practice. The law amends the Fair Credit Reporting Act to prohibit credit bureaus from selling mortgage trigger leads except in narrowly defined circumstances. After March 5th, a bureau can only share your mortgage inquiry data with a company that already has an existing relationship with you, meaning your current mortgage servicer, the lender that originated your existing loan, or a bank or credit union where you already hold an account. In practical terms, cold outreach from companies that have no prior relationship with you, the random calls, the misleading texts, the impersonation mailers, is now illegal. The era of the trigger lead as an open marketplace is over, at least for mortgages. This is a significant consumer protection win. It passed the Senate unanimously and the House by voice vote. One of the rare pieces of legislation with genuine bipartisan support. Industry groups from the Mortgage Bankers Association to the National Association of Mortgage Brokers backed it. 10 states had already passed their own trigger lead restrictions before the federal law arrived. But, and this matters, the law has limits you need to understand because the system didn't disappear. It got smaller. Limit number 1, the ban only covers mortgage trigger leads. If you apply for an auto loan, a personal loan, a credit card, or any other form of credit, the credit bureaus can still sell that inquiry as a trigger lead under the existing FCRA framework. Your intent to borrow for a car, a boat, or a balance transfer is still a product for sale. This law protects homebuyers. It does not protect borrowers more broadly. Limit number 2, existing relationship exceptions are broad. Your current bank can still contact you if you apply for a mortgage elsewhere. Your current mortgage servicer can still be notified. If you have a checking account at a large national bank and you apply for a mortgage with a local broker, the bank may reach out with a competing offer, and that's permitted under the new law. The relationship exception means the biggest institutions with the most account holders still have a pipeline of data. Limit number 3, pre-screened offers for non-mortgage products continue. The credit bureaus can still generate and sell pre-screened lists for credit cards, insurance, and other financial products based on your credit profile. The trigger lead mechanism, selling your data when you demonstrate intent, is restricted for mortgages but remains available for every other product category. Limit number 4, your existing data is still out there. If you applied for a mortgage anytime before March 5th, 2026, your trigger lead data was already sold. It's already in the databases of lead aggregators, marketing companies, and competing lenders. The law stops future sales. It doesn't recall past ones. So what do you actually do? The law did the heavy lifting for mortgage trigger leads, but protecting yourself across every other category of borrowing requires action. 1. Opt out of pre-screened offers immediately. Visit optoutprescreen.com. This is the official service run by the credit bureaus. Ironically, the same companies that were selling your data, that allows you to opt out of pre-screened credit and insurance offers. You can opt out for 5 years online or permanently by mailing a signed form. This doesn't stop all marketing, but it removes you from the pre-screened lists that bureaus sell to lenders and insurers, which eliminates the primary mechanism for trigger lead style targeting. 2. Register with the National Do Not Call Registry at Do Not Call. This won't stop every call. Companies with an existing business relationship are exempt, but it adds a legal layer that makes unsolicited telemarketing riskier for the companies doing it. 3. Freeze your credit when you're not actively borrowing. A credit freeze prevents any new hard inquiries on your report, which means no credit pull, which means no trigger, even in the categories not covered by the new law. When you need to apply for credit, you temporarily lift the freeze, complete the application, and refreeze. This adds a few minutes of friction, but it eliminates the trigger entirely. 4. If you're applying for an auto loan or personal loan where trigger leads are still legal, batch your applications within a 14-day window. Credit scoring models rules treat multiple inquiries for the same type of loan within a short window as a single inquiry. This limits the number of triggers generated and reduces the duration of your exposure. 5. Whenever you do get unsolicited contact after a credit application, ask the caller directly, "Did you obtain my information from a trigger lead?" They are required to disclose how they got your data. If they refuse to answer or deflect, that tells you something about the kind of company you're dealing with. Legitimate lenders will disclose, predatory operators will not. The trigger lead story is really a story about something bigger than mortgages. It's about who owns your financial data and what it means when the answer is not you. For 3 decades, the credit bureaus operated a system where the consumer was the product. You generated the data, they sold it. You bore the consequences, the calls, the confusion, the pressure, the occasional bad decision made under manufactured urgency, and they collected the revenue. Your intent to borrow was monetized at the exact moment your capacity to make careful decisions was at its lowest. The Homebuyers Privacy Protection Act changes the rules for mortgages, but the underlying architecture, private companies collecting your financial behavior and selling it to other private companies without your meaningful consent, is still the default across the rest of the credit system. The mortgage ban is a crack in the wall, not a demolition. The people who protect their wealth in this environment are not the people who assume the system is looking out for them. They're the people who understand that every interaction with a credit bureau is a transaction. And in most of those transactions, they're not the customer, they're the inventory. The opt-out, the freeze, the do not call registry, the batched application window, these are small moves, but they're the difference between being a participant in the financial system and being a product of it. For the last 30 years, your phone exploded when you applied for a loan because 3 companies figured out how to monetize your stress. Now you know the mechanism, and now you know how to shut it off. I'm not a financial advisor, lawyer, therapist, or any other licensed professional. The content on this channel is for educational and entertainment purposes only. Everything shared here reflects my personal opinions and should not be taken as financial, investment, legal, medical, or relationship advice. Any stories, examples, or characters used are composite illustrations meant to explain ideas, not to represent real people or specific situations. Real-life outcomes vary widely because everyone's circumstances are different, and any statistics referenced may come from studies with limitations and may not apply to every individual. Always do your own research and consider your full situation before making important decisions. When needed, consult a qualified professional who understands your personal circumstances.